Good morning. We are half an hour from the open in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Annabelle Droulers.
Our top stories: President Trump's 90-day pause on most higher tariffs sends Asian stocks surging. That's after Wall Street's best rally since 2008. The about face also triggering huge swings in bonds.
Now, the president excluding China from his trade war reprieve, raising duties to 125%. That comes after Beijing's latest retaliation, but saying he may not have to hike even further.
And other Asian economies racing to avoid an escalation. Taiwan presents a roadmap for deeper U.S. trade ties, while Vietnam agrees to start negotiations on a deal. All right, taking a look at the market action this morning, and this has really been an incredibly volatile session. I mean, there's really a lot to digest from Wall Street, but just to sort of put that timeline in context here, equities had really been sort of flipping between gains and losses throughout the session. In the morning, you came into the early afternoon, President Trump issued this 90-day reprieve, and then you saw that huge rally. And so, again, that is really what's translating into the morning session so far. I mean, you've just got the likes of Taiwan, for instance, coming online 9% to the upside. It has really been slipping throughout the course of the week. TSMC, of course, you can see there a 10% jump, the heaviest weighting on the index. Again, tech stocks, one of the big gainers overnight. Really, equity story. This has also been a story around bonds as well, and huge moves here. We've seen yields jumping at the front end of the curve, these changing expectations around what the Fed does. But then at the longer end as well, again, we'll dig into all these details in just a moment, but just suffice to say, big moves in the bond space. Equities-wise, or currencies-wise, rather, you've seen that dollar retreat somewhat. U.S. futures here, again, just fractionally firmer. But let's take a look and put that into context with the VIX as well, because that was the single day biggest jump we have seen on record here. So, again, going into the close on Tuesday, you're above 50 on this. You're now down around 33. So huge moves here. Taking a look at the Golden Dragon Index, even though this Trump reprieve on tariffs excludes China, and actually you've seen that tit for tat escalating even further, you did actually see some gains for the Golden Dragon Index overnight. Taking a look at futures as well in the session today, what we see so far, and again, pointing to some possible gains for Chinese equities. But Dave, certainly looking a lot more muted here than what you see in other parts of the Asian market.
Yeah, and gains, but not to the extent, to your point, that we're seeing across the region, which I guess juxtaposes the China story now against everything else out there, right? So it's, we've coalesced and we find ourselves where really, people had suspected we'd find ourselves in, really, something between the U.S. and China, mostly. In fact, let's take a look at how this is being covered and for this trade war front and center across Chinese state media today. And here's a quick look across some of the newspapers we're looking at here. So we'll start things off. People's Daily have published the full text of China's white paper outlining its official position on trade relations with the U.S. And the document accuses Washington of failing to meet its obligations under the Phase 1 trade deal back in 2020 and undermining economic and trade ties. Now, on the other hand, it also says that China has scrupulously, okay, that's a difficult word to get out there this early in the day, 5 syllables, I think, honored its trade agreement with the U.S. as well as upholding free trade principles. Despite rising tensions, it ends on a positive note, saying that both sides can resolve their differences through dialogue and mutually beneficial cooperation. Bell.
Yeah, Dave, let's get more on this story now. Bring in our China correspondent, Min Min Lo. So, Min Min, look, as we've been saying, China is really standing apart now from other economies. So what's been the action in terms of tit for tat overnight?
Well, China actually hasn't responded to the latest round of escalation because it happened overnight in Asian times. And so we'll have to see. There is a Chinese Commerce Ministry regular briefing every Thursday, so we might get some statements from the Ministry of Commerce later today, so hang tight. But if you look at what China has said so far, they said they are going to fight till the end. And if the past action is anything to go by, we might see China continue to hike tariffs to match the latest round of escalation. So yesterday, after the reciprocal reciprocal tariffs kicked in hours after that. China had announced it's raising the levies on U.S. goods from 34% to 84%, matching that additional 50% that was imposed by Trump. They also had a number of non-tariff measures, including adding about a dozen companies into an export control list, but quite a symbolic move given many of these companies don't actually have a lot of business in China. They also put a number of U.S. companies, mostly defense contractors, into an unreliable entity list. So China has already said this is mistake upon mistake, what the U.S. is doing. So you might ask what sort of levers that China have right now. One, they could maybe decide to pause any cooperation on fentanyl. They could limit U.S. exports of services to China. They could continue to tighten the noose when it comes to the rare earths as well.
It seems that they're further and further apart by the hour on any potential deal here.
Yeah, Trump is just saying that he thinks that China wants a deal. They just don't know how to go about it. He said the presidency is a very proud person. And bear in mind, the White House also said that President Trump has a spine of steel. He's not likely to bend. And that's the sort of rhetoric, the sort of description that you would hear China describe themselves as well. So you have two strong men here playing the game of who's going to blink first in this staring contest. And one of the sort of barriers to both sides coming to the table is also the differences in the way policymaking is done in U.S. and China, because Trump fashions himself as this negotiator. He wants to cut a deal directly, leader to leader. But for China, that's not how the Communist Party protocol works. China would prefer lower level negotiations. They would go to a leader level discussion only when they know there is a clear outcome that will be acceptable to China, that won't be an embarrassment to presidency. They view that top level discussion as a culmination of discussions to seal the deal rather than an opening or a beginning of negotiations. So that is one of the reasons they are at an impasse as well.
Min, thank you so much. Min Lo, our China correspondent there. Now, as we're looking at, ahead of the open here, 23 minutes away, so equities are called higher about 1%, give or take. Asia Pacific, though, as we were just pointing out, I mean, Taiwan just coming online right now. Record gains there at the open, about 10% in Taiwan. It's somewhat of a similar picture, although not to the extent in terms of magnitude when you look at the bond market. So you have the curve right here. Well, you have the 10s, U.S. all the way down to Japan. So we're down a little bit. Certainly, we haven't completely retraced the massive melt up in yields that we had yesterday. What was that all about? Was that a rush to cash? Was it a weaponization of certainly one investor's holdings in another's treasuries? Let's get a sense of that. Ben Bennett is here with us, Asia Head of Investment Strategy at asset manager L&G. Good morning. Nice to see you.
Good to see you too. Thank you for having me.
Why don't we start with that? You know, there was a notion out there that the meltdown in Treasury yesterday was down to one big seller.
Yeah.
Without naming names.
Yeah.
Any signs of that?
It was chaos yesterday. And Legal & General, where I work, is a big UK asset manager. And we had sort of feelings of the Liz Truss type meltdown a couple of years ago, if you remember. So, I mean, it was quite scary at times. But I think it was more to do with liquidity calls and people selling maybe their winners, selling what they can sell. I think it's hedge funds. I think it was asset managers. I think sort of sovereign funds, they don't hold those sort of long-dated bonds. Anyway, certainly not long-dated JGBs, which were also melting down, weren't they? So I don't think it was that. But it was perhaps it was that chaos was another example of bond markets impacting politicians. I think that's a famous saying. I think Trump's blinking might have been something to do with those bond markets.
So wasn't concerns around sort of the sustainability or the safety of US debt, for instance?
I mean, the US can't default. I mean, they could always print money. They've done that in the past, so they wouldn't default. I think it was really to do with liquidity calls. I think it was that sort of volatility shock. Look, I mean, if equity markets go down, what were they, 1.20% down S&P? I mean, that's going to impact your VAR models. And when you have shocks like that, you tend to get collateral calls, and I think that's what it was, to be honest.
So what's the strategy now?
Yeah, so, I mean, we were okay going into this sort of mini meltdown. We were relatively cautiously positioned because we thought what was going to happen on the 2nd of April, no one knew, and it could easily have been worse than expected. It was worse than what we thought. Right. But we actually covered some of those underweights. So equity underweights that we had, we covered some of those. We were also long duration, thinking that might have hedged us. Luckily, we covered that as well because it didn't hedge, did it? That actually exacerbated the move. Right now, though, we're much more neutrally positioned. I don't think this is over. There's still an awful lot of volatility to come. The markets are still very uncertain. I mean, we're talking here now, anything could happen. But imagine if you're a business leader making investments, you have to put those on pause, don't you? So recession risk is still elevated. I think at this point, we would be a seller on strength right now if the rally continues to go.
What does positioning neutrally, though, look like right now, given how much uncertainty and how unpredictable it is as well?
So within our risk assets, we generally like to be underweight credit and overweight a little bit equity. So that's a neutral overall, but I think credit hasn't moved as much as equities did.
Yeah.
So credit spreads only widened by sort of 30 basis points. In a recession, so US investment-grade credit started at sort of 75 basis points. That was the tights a few weeks ago. They widened out to about 120, so that's a little bit of a move. In a recession, they go 200. They were 600 in the global financial crisis. Whereas equity markets generally, in an average recession, fall 30% or so, the S&P. And it got down to 20. So actually, the S&P was reflecting a reasonable chance of recession. It's now recovered half of that, I suppose, but it's still a bit of a recession premium priced in there, but not for credit. So I still think we prefer that equity to the credit markets within our multi-asset portfolios.
Right, and maybe just a point there on why spreads were somewhat honest. Is that, I don't know, is that because of the melt up in sovereign bonds, for example? I'm wondering whether there's something to those spreads being behaved more than meets the eye.
Yeah, I think that's right. I think the bond yields going up just meant that yields were still relatively attractive, so there was still, people didn't really want to sell at these high yields, did they?
Right.
Also, I mean, equities are just going to be a more liquid hedge. Within credit, CDS did move a fair amount. That's where people put on their hedges. But the actual bonds, it takes a little bit more to sell the bonds. And back to the point about treasuries, maybe it was harder to sell those corporate bonds. So people actually had to sell the treasuries to raise funds anyway. So maybe the illiquidity helped them a little bit there.
How are you thinking about recession risk right now, then?
Yeah.
I think it's still elevated. Look, I mean, the numbers that I said before, 30% recession correction. We've got 10 now in the S&P. So that would infer a 1 in 3 chance of recession. I don't know. I think it's maybe a little bit higher than that because we're still a little bit cautious. I do think what happened overnight reduces the chances of a big recession. So, like I said before, the global financial crisis, 50% correction in equities or more, wasn't it? And we saw that maybe early 2000s too. So I think that tail risk has been reduced at least, but there's still a decent chance of a downturn. In terms of businesses, investments, hiring, and also the consumer's going to have to bear these higher costs, higher prices when they come in. There are still tariffs coming in, aren't there?
Yeah. How do we know when we're past the hump here? I mean, certainly you look at the price action today. There's a relief rally across most parts of the market. We tend to get these big moves in risk assets in the midst of a bear market. So how do we know when we're still in a bear market? How do we know when we're past the hump? Like, what are good indications of
Yeah, bear market rallies are the most brutal. We saw that yesterday, didn't we? 10% move. So we don't know until right at the end, until I guess we got certainty. I still think we're in this correction, so that's why we would be a seller on strength. Let's see how things open today. I do think the market move yesterday was exacerbated by some of those ETF leverage money coming in at the end and having to buy at the end. So maybe that was a little bit overdone yesterday. And again, I still think we're in that correction phase.
Thank you for the insights. Nice to see you. Let's talk again soon. That was Ben Bennett, their Asia Head of Investment Strategy at LNG. Right, we're looking at a couple of names here. I mean, this is just one example of this broad cohort of, say, the Vietnam-related plays right now on the back of breaking news, related news earlier on that Vietnam and the U.S. are in talks, of course, for potentially moving back from the edge there. So Stella International is really one of the stocks we've been tracking here. I'm just doing some rough math. We're called, I would say, this looks like a 20% move right now in Stella, among other names we're tracking listed in Hong Kong that do have some capacity and exposure in Vietnam. So a group to watch here, of course.
Yeah, just to give the context, Stella International is a footwear maker for brands like Nike, for instance, but also a lot of the luxury plays as well, has big manufacturing presence in Vietnam. So certainly one very exposed to this story, but more on that with the market open. Coming up as well on the China show, we're going to be talking portfolio strategy with the founder of Singapore-based hedge fund APS and Asset Management. Find out where Wong Hoy is seeing opportunities next, and we're counting down, of course, to the open of trade in Shanghai, Shenzhen and Hong Kong. You're watching the China show. Futures looking for some very modest gains, but of course, Trump tariff reprieve not for China. More ahead. We just got the yuan fix this morning, and again another day above the 720 level, so 720.92. The estimate had been for 735.06. I mean, it goes without saying, really, that these yuan devaluation risks are going to be persisting, especially given what's happened overnight. President Trump's issued this 90-day pause on higher reciprocal tariffs for most countries, but China, of course, not part of this.
No, and we have in fact fantastic lineup of guests coming through as well. We're talking equity markets in a couple of seconds, but just before that, just to flag, Goldman Sachs Chief China economist Shan will be joining us at the bottom of the hour, and of course Becky out of Standard Chartered will also be joining us to talk us through. There is a difference between flexibility in the currency and a one of devaluations, stating the obvious, but you get more of the former. At some point, you don't know it, you cross the line into the latter, right? So we'll see where the exchange rate goes and what the assumption should be moving forward. Yeah,
but as we said there, the week of fix now for a sixth straight session. But let's also talk about the equity picture. Bring in Wong. He's founder of Singapore-based hedge fund APS Asset Management. Thanks so much for joining us this morning. And I mean, it goes without saying, really, that this is a very, very challenging environment to be operating in. So how are you also managing what we've been getting with tariffs?
I think, firstly, to make sense of what has happened last week, one has to see beyond the day-to-day fluctuations and understand the events and happenings in the past week in the context of a very large mega trend, which I think is the decline of the U.S. as an economic superpower and the rise of China. Which should therefore mean that China-U.S. relations are quite unlikely to improve. And that has been the position taken by us for many years.
Well, this White House is trying to change that mega trend. And I'm wondering whether that's an assumption that we need to be considering, that they are able to achieve a version of that, and we can trade off that investment theme.
Now, yes, I would agree that the U.S. must take more decisive action to fix the trade deficit, budget deficit, and so on. But I'm less sure whether engaging the world actually in a trade war will solve U.S. problems and the world's problems. Now, the U.S. and China are the two largest economies of the world. As I can see, they have gone into a full-fledged trade war, which would not harm just China's economy, the U.S. economy, but also the world. If there's one winner, I think it will be Russia. But the world will be a loser.
OK, so sticking with that thesis then, I guess, of the US as a declining superpower and rising China, how do you then position your portfolio? What investment decisions are you making?
So for a number of years already, we have positioned our China portfolios defensively. So we have cut almost all our exposure of Chinese companies that do business with the US. So our portfolio is positioned in defensive sectors, if you will, i.e. Companies that have China-centric businesses, i.e. they don't export to China. That's one. And two, because of the bear market the last few years, many Chinese stocks have been sold down to very cheap levels. So these are the ones that I think will hold up much better. Things like China Mobile and so on, where 99% of the revenue and profits come from China.
So what are your biggest holdings now? What are the biggest adjustments you've made this week, if any?
Not very much. Our number one holding is still SMIC, the foundry. So, SMIC, I think, will be a major beneficiary of this trade war, because China will have no choice but to make sure not just SMIC, but the entire semi-industry, to get stronger, to be more independent by developing the technologies in the entire food chain, from semiconductor material, equipment, manufacturing, packaging, and so on.
Right.
I mean, this is what I think we are already seeing happening in the last few years, and this will accelerate for sure. And two, I think, with the emergence of DeepSeek, China will use AI to increase the productivity of all their industries so that their products will be more competitive. Yes, most of the products, I think, will not reach the shores of the U.S. because of the 125% tariffs, except for those components that go to products that are made in the U.S. Let's say some of the car components that GM and Ford import from China. They will have to pay the full duty. And over the weekend, one Chinese component manufacturer told investors that they will not shoulder even 1% of the tariffs. And that was even before the 50% additional tariffs were imposed on China products. So, I think investors' focus have been on the damage that will be done to the Chinese economy. Sure, the Chinese export sector in particular will be hit hard. And therefore, they will have no choice but to direct exports to the other markets and to their own domestic market. But U.S. companies will also be hit very hard. Take, for instance, Walmart. 60% of their products on their shelves are China goods. So I can't see how, for instance, Walmart could replace the China products with products from other countries. Even Amazon's products sold in the U.S., 70% of them are China products. In the case of Apple, it's even more complex, right? Because in addition to iPhones or Apple products made in China and exported to the U.S., Apple also makes the products in China and sold to the Chinese. So in this full-fledged trade war, I'm not sure how the Chinese consumers will react.
Like Tesla. Tesla also has the similar.
Even Tesla.
But I do wonder whether there'll be sort of company-specific or product-specific exemptions like we saw in the first trade war. Like maybe individual products like the iPhone could end up being exempt. What, though, are you hearing in your meetings with Chinese investors? What are sort of the key points or key questions that you're being asked?
One is that, of course, the exporters in particular expressed concern that the 75% tariffs was really very damaging to them. But with the extra 50%, I think they wouldn't know how to react. But strangely, Chinese investors are more calm. I think that's partly because for many years, the U.S. have been taking a lot of actions against Chinese companies. So to some extent, I think they have adapted to the hostile U.S. actions against them. And I think the government's assurance that they'll do what they can to minimize the impact from the U.S. Tariff actions maybe also calm some nerves. But all said and done, I think we have entered into a period of great uncertainty, a period of irrationality. And therefore, I think the risk premium, not just for China, but for all markets, will go up.
So a couple of things that we're tracking here, everything from market and currency support. We talked about the fix. Massive turnover coming through this market, right? You have southbound flows reaching a record yesterday. 7.5 billion shares traded on the Hang Seng China Index. More coming up, including the open. We're poised to open higher today. This is the China Show.
Welcome back. You're watching The China Show. We're counting down to the open of markets this morning. We are seeing risk on across Asia today. China's looking to take part in that just a little bit, really. We're not going to see the exact amount of upside, I'd say, across the session, and that's because, of course, the tariff reprieve from Trump does not extend to China. So you won't see perhaps the same level of positivity, but still some upside indicated there.
Yeah, I think we're up, let's call it 3% on this. We're obviously approaching the open right now. Now, to Belle's point, right, if you think this is good, look at these next boards coming up as well, right? So you have U.S. futures, 10% move up overnight on the S&P. Futures are still pointing higher in the Asian session. It was the biggest intraday swing in the S&P, 11%. Going back to the GFC. S&P futures, okay, correcting myself right now. We're pulling back a little bit right now, although you are getting some upside over in Europe. Can we look at the open, please? We're at the open already. Let's flip the boards, please. Completely ditch this and get the dashboard up, please, if we can. Mainland markets are opening up. Let's get that up, please. The fixed sixth session of weakness, 1.7% to the upside. And maybe just a production note, can we get those other boards on the end of this, please, so we can look at other markets too, like Taiwan is up about 10%. Okay, let's have a look at Hong Kong now, please. And while we look at that, too, just to mention that we are also getting the inflation numbers coming through. I do not have enough screens on my Bloomberg for everything I need to track at this point in time. 4% on the Hang Seng Tech. I would imagine everything is up. Everything, at least from a sort of large cap perspective, bottom of your screens is up right now. Interesting note, though, you look at the exchange rate between the Hong Kong dollar is now trading at the strongest level against the Chinese currency in about 17 to 18 years. You do that pair. Effectively means, pardon the pun, additional tariff if you're going from the mainland to the stock connect into Hong Kong. But that being said, valuations have obviously also corrected given the 20% drop in Hang Seng. So that might be more a compelling long than it is. You're getting inflation also coming through there, and we'll talk about Vietnam, link stocks, a bit later on. But yeah, what do we talk about inflation, though? Yeah,
let's talk about the inflation because we just got the figures coming out, and we can start off with CPI that fell. So we had seen a 0.7% drop in the month prior. It's just come in as well for March, a decline again for a second straight month, I believe, of negative 0.1%. So, yeah, still deflationary territory there. PPI, we've actually decelerated for a 30th straight month, I believe, as well. So a drop or a contraction of 2.5%. The survey had actually been for negative 2.3, so worse than the estimate there. But certainly, I mean, this was a period in March where we had the stimulus being unveiled at the MPC, not likely or really to be captured perhaps until another few months into the year. I guess the question as well is, how much does this sort of is this even going to be dominating any sort of narrative today when you've got tariffs, of course, as really the primary focus? I almost forgot inflation was coming out today, actually. I was reminded by that right before we came into shows, really. Just to underscore the point that Belle was making, right? There's a lot of stories out that tariffs are dominating proceedings, including as well the offset coming through from Chinese policymakers and really efforts to support the equity market. In fact, just on that very, very note, some final thoughts right now from Wong founder of Singapore-based hedge fund APS Asset Management. Can we trust that the floor is in the equity market in China?
It will depend on the will of the Beijing government, whether or not to support the stock market under all circumstances. My best guess is that they will try. That's what they did yesterday.
The other thing I want to point out as well is the reversal we had overnight in U.S. markets, as an example. Headline risk is increasingly immense at the moment. 11% swing. We opened lower, I think, 2% on the S&P. We closed higher by something like 10%. We tend to get massive rallies within bear markets. And I'm wondering, in your experience, what is the best indicator that the market bottoms behind us? Or if we're still in the midst of figuring things out?
I think three key factors. One would be earnings. Eventually, share prices will react to earnings. Two, I think, will be interest rates, which in turn will be dependent on inflation. Now, with this trade war, I think U.S. inflation in particular must go up. So in coming months, especially on year-on-year comparisons, you'll see ugly CPI numbers. Three, I think, would be the risk premium of financial markets. As I see it today, I think the risk premium for most U.S. asset classes have gone up, and I think will continue to go up because there is no predictability of U.S. policies. Say in the last few days, policies have flip-flop every few hours, right? And that is something that investors don't like. And therefore, the risk premium, I think, has already gone up and will go higher. In short, I think financial markets have entered into troubled times, turbulent times.
Yes, certainly. I mean, we see that, I guess, the VIX a little bit off today around the 30 mark, but it has been, at above 50. So it really indicates just how much uncertainty that traders are dealing with. But that was Wong there, founder of APS Asset Management. Thanks so much for your time this morning. And let's bring in Shan as well, because the chief China economist at Goldman Sachs is with us this morning. And certainly a very difficult environment to be making any sort of forecast in right now. But we won't start there. I think we can start instead with what we were just hearing then about really that level of policy unpredictability that we see from the US could actually be one of China's strengths in this, perhaps a bit more policy certainty. But how do you think, aside from the national team stepping in to step up or prop up market sentiment, what do we expect in terms of the monetary or the fiscal levers here that they're going to be pulling on, chief among them perhaps currency ones?
Right. I think you can think of a policymaker's reaction into a few different buckets. Three, let's say. The first one is stabilizing the volatility in the market. That includes equity market, FX market, rates market. So as you were saying, every few hours things are changing. It's very hard to see how this is going to play out. So in a way, you need a bit of time to let investors know what your stance is, where the bottom is, how you want the market to be responding. And once the sort of jittery in the market is calmer, I think the monetary policy easing, fiscal policy easing, all the policies we discussed previously, whether it's giving money to families with multiple kids, whether it is doubling down on consumption-related or investment-related spending, those will likely be rolled out. And the third bucket is really to think about what else to do, right? You have this three-digit tariff rates that we certainly did not anticipate. I think a lot of market participants didn't, including policymakers. So what else do you do in addition to the instruments and tools that you already discussed and ready to roll out?
As you were just talking there, I'm not sure we should be surprised at this. The onshore renminbi actually just hit the lowest since 2007. I think Scott Bessent overnight was effectively urging the Chinese not to devalue the currency. How do we need to be looking at the currency right now? If you look at the magnitude of a change in USD CNY, it's not that big, right? 335, 340 is a very small change. So we don't really think this is really aiming at offsetting a 100% tariff. The type of a currency, not even close, right? So I think of this as letting off some of the pressure, currency depreciation pressure. And I think this is perhaps another indication that China's reaction function is somewhat different. The first couple tranches of Trump tariffs, the fentanyl-related tariffs, China's reaction was much more restrained. You look at how much counter-tariff they announced, very small, even if it's 10% is on the sliver of Chinese imports from the U.S. versus now is 34%, so 50% is on everything we import from the U.S. So similarly, in the FX market, there may be a little bit of a change in reaction function as well. But by Chinese policymakers' style, I doubt they will let currency move in a dramatic fashion. So we're just seeing more gradual and daily fixing inching up. So that could be the style we're witnessing in the coming days.
Okay, so it's not really about sort of going for the nuclear option straight away. It's sort of more of a staggered move. But is there going to be anything that tells us concretely that Beijing has opted for the most extreme response then?
Hard to tell. We don't know. Policymakers are I think they are also calibrating the situation. This is new to us. This is new to policymakers as well. I think at this juncture, it's really hard to say what both sides are going to do. What we know is that tariff rates are extremely high, and bilateral trade is likely to plummet if this is the level of tariff we're going to see in the foreseeable future. We actually did some analysis looking at who is more reliant on whom. If you have this high tariff, we look at over 20,000 products. And we find that U.S. is more reliant on Chinese goods because in all the U.S. imports of Chinese products, 1/3 of them, China's market share is more than 70%. Meaning, even if you want to find alternative supplier, it's very hard to do that. Whereas in China, only 10% of the products China import from the U.S., where U.S. is a dominant supplier. So we'll see. Both sides are going to feel some pain if such elevated levels of tariffs stay, but we'll see what happens next.
Yeah, I can't even imagine how you do your job right now, right? The parameters and assumptions are swinging between extremes almost on an hourly basis. So given what we know right now, let's assume this is the worst case. Triple-digit tariffs. What's the hit to growth in China?
So when you look at the tariff rates, it's not a linear relationship, right? If I add another 1,000% tariff on or 2,000% tariff, that has no impact whatsoever. Right. Trade will just stop. When we look at the nonlinear relationship, what we find, the first, let's say, 50% tariff on Chinese products is going to weigh on China GDP level by about 1.5 percentage points. Okay. It's sizable. The second 50%, that goes down to below 1%. If you add furthermore, it's getting smaller and smaller, and eventually converts to about 3% of GDP, because that's the size of U.S. bound exports as share of China GDP.
Yeah, I think you were saying it was 0.9%, I think, for the next 50. So what I'm wondering, though, is it's not just the relationship or the trade relationship between the US and China. How are you also factoring in China's trade relationship with other countries as well, and the concerns maybe that they're also going to have and perhaps become a little bit more protectionist?
Absolutely. That is the question clients are asking us, because after all, U.S. bond exports only 15% of Chinese exports, right? You can manage that if that's being hit really hard, because you have 85% of your exports going elsewhere. But if other countries are erecting trade barriers, that will be much harder to handicap. Chinese industrial production, 25-30% of that goes to exports. If everything gets shut down, it's impossible for Chinese economy just to absorb all of that. So this is where I think that Chinese policymakers are probably also thinking about how do we strengthen, what else can we do to strengthen relationship with other trading partners to ensure that 85% of our exports at least stabilized and not moving too much.
I think a few days ago, and I'm paraphrasing here, I think Premier Li Qiang said they have enough policies to offset the weakness that is likely to come through. What do you think he means? What are the policy offsets you think we'll see coming out of China to shelter the economy? Yeah,
I think he has a point there. If you think about compare a smaller country like Vietnam versus China, right? China, I mentioned, export to the U.S. is about 3% of GDP, whereas Vietnam is double digit. Right? So if you have a double-digit trading with the U.S. and U.S. have a huge tariff on you, it's very hard for you to offset 10% of GDP, even if you have fiscal room. Right. Versus if you're just going to offset 2-3% of your GDP, then by expanding fiscal deficit by a few percent of GDP, it's plausible that you can offset bulk of that. So that's where I think Chinese policymakers are probably thinking about ways to offset that tariff impact.
Forgot to ask you. Inflation came out. Negative 0.1% year in year. Do I even bother with this right now? How is this relevant to the greater scheme of things?
I don't think you need to think too much of the monthly numbers right now, because we had January upside surprise, February downside surprise. The Lunar New Year food price fluctuation is generating volatility. Bottom line is Chinese inflation has been low for the past couple years. And now having a tariff war with the U.S. and potentially not being able to export your part of your production capability, this is just another layer of deflationary pressures. Our commodity team revised down oil price forecast significantly on the back of a slowing global growth and higher tariffs. So the simple logic is that you already have a low inflation, having trade war, having lower commodity prices. So we remain below consensus on inflation forecast in China.
Wei Shan, thank you so much for taking the time. Nice to speak with you on such a busy day, busy week. It's an understatement. Wei Shan there.
Of the century, actually.
We're barely 40 minutes into the show, and I'm already get me out of here. Chief China economist there at Goldman Sachs. Markets, as you can see, are rallying. A look at Greater China. This is happening also elsewhere, apart from U.S. futures. Plenty more ahead. This is the China Show.
You're watching the China Show, and it's a story of tariff reprieve for some, of course, excluding China this morning. But one of the headlines crossing overnight has been Vietnam and the US agreeing to start trade deal talks after that 46% tariff was imposed. So these are some of the names that are linked to that. We've been talking about Stella, for instance, this morning. It's a company that makes footwear for the likes of Nike, but also luxury companies as well. And we are seeing, again, broader upside here.
Yeah, in fact, just let's get into this very story, because while China has retaliated, you have others that haven't, right? So you have the likes of Vietnam. They're opening or seeking negotiations with the U.S. I'll add Japan in there. You have South Korea. You have Taiwan. In case you missed, I think last week, the Thais also indicated their interest in opening up negotiations with the U.S. So let's get a sense, really, of how the rest of the Asia-Pacific, ex-China, is navigating this turbulent time. Joining us here, of course, is Rebecca Chung-Wilkins, of course, to help us understand. Let's start with Taiwan. What is Taiwan doing specifically?
Yeah, so we had this opinion editorial by the leader of Taiwan laying out really his approach to negotiations with the US. But there's two important messages. The first is really this appeal to Donald Trump's own domestic concerns here. He really sort of went to emphasize that trade with Taiwan is essentially good for the US. It creates jobs. It creates manufacturing jobs. He pointed to this $8 billion deal that they did over arms during President Trump's first term. He also pointed, of course, to that TSMC outfit that they're building out in Arizona, essentially really very much appealing to the sorts of things that we know that Trump is concerned with at home. The second part is laying out this four-stage plan to try and improve that trade surplus that Taiwan has with the US, explaining in part that part of that actually comes down to this very strong demand for AI that has, seen really great appetite for chips, and that's led to this increasing a trade deficit that the US is now dealing with. It's promising to buy more things like energy, agriculture, other sort of industrial sectors as well, and continuing essentially to invest in the US to try and create more jobs. So a very clear message, I think, from Taiwan there. But of course, you cannot separate that broader message from the geopolitics here. That is deeply intertwined. There is this fundamental question about just how much support that President Trump and the US is going to continue offering Taiwan when it comes to US-China relations. We know, of course, it's a red line for Beijing, has continued to be, but there will be this anxiety that Taiwan somehow becomes a pawn in those discussions between the US and China. So that sort of geopolitical element, of course, underlying and sort of very much in the subtext there as well.
Yeah, what sort of guarantees would be in place? So what about the other countries as well? Japan, South Korea, Vietnam, we've already spoken about.
Yeah, and it is important here that we're all talking about Asian nations. This is the region that has really been hit hardest by the reciprocal tariffs. We're seeing negotiations pushing ahead on all those three fronts. And interesting to hear also sort of positive murmurings from the White House. So Japan is dealing with a 24% so-called reciprocal tariff, a 25% auto tariff that came in a bit earlier. We now have two officials in Washington, to lay the groundwork for these broader negotiations that are going to happen at a higher level between the economic revitalization minister for Japan, as well as Jamie Greer, who is the US Trade Representative, and Scott Bessent. We've heard Bessent saying Japan is an important economic ally, giving those positive indications. South Korea, slightly different story, but again, these positive soundings coming out from the White House. We had this call between President Trump and acting president for South Korea. Essentially, they're saying they're going to leave it up to their US trade representatives to do a deal, but it does look like a deal can potentially be done. It's going to be a very busy week for James in Korea, who is the US Trade Representative. He, of course, also was meeting with the Vietnamese Deputy Prime Minister, who is there also. As you said, we're starting to see negotiations being opened. Now, someone that we haven't actually had much mention of yet, but I think is worth keeping an eye on, is also India. There's been a lot of discussion around opening up India's services, particularly when it comes to rebalancing. So potentially we could just, I guess, keep an eye out for something on that front. For all these countries, the difficulty is that the demands and the priorities from the White House do seem to be shifting. On the one hand, there is this emphasis on fixing the trade deficit, but there's also this question of believability that Scott Bessent and others have talked about. How do you actually convince someone that you're going to do enough to try and rebalance that trade deficit?
Yeah.
And what if the goalposts start to move halfway through the negotiations? And what if your interlocutor may not actually have the influence to carry that deal and that negotiation that you've discussed all the way through to convince President Trump to sit down and finally sign it? So there are a lot of challenges for particularly these Asian nations. But I do think it's interesting to see. We have, upwards of 50 countries potentially knocking at the door for the US to have these discussions. Very, very interesting to see that it's South Korea, Japan, Vietnam, who are managing to get meetings, managing to sit down and actually have face-to-face discussions at some level.
Rebecca, fantastic there. Rebecca Chin-Wilkins there. That one name that wasn't in there, of course, mainland China. So very far apart as far as the potential deal is concerned. Okay, so while we were just having that conversation, we're looking at the Kazuyuki index. So effectively, you're getting a circuit breaker coming in because of all the buying taking place. We're up 5% on the benchmark itself. Just a case in point, 1,800 stocks in the Kazuyuki index. Nearly everything but about 100 of stocks are on the way up substantially as well. So you are getting something triggered, call it the sidecar, and we understand based on the last time this happened, but to the downside a few days ago on Tuesday. It's a pause for 5 minutes. We'll get more on that and update you guys, of course, once we have more information on what's going on. And there's a lot of it going on right now. This is Bloomberg. Right, welcome back. It's a marathon, as they say. It does feel like a sprint, though, on a day-to-day basis, hourly basis. Hang Seng Index is now up, and we're now pushing the 21,000 handle on this after taking out 20,000 less than 24 hours back. USD CNY in focus, 735, a level we haven't seen in 18 years. Plenty more ahead. This is the China Show.
Welcome back to the China Show, taking a look at the Hang Seng half an hour into the session this morning. Ooh, a bit more upside. So we are now 4% in the green today. Hang Seng Tech leading that up more than 5%. It's very risk-on across the Asian session. Today you're seeing lots of markets that are rallying, and that really follows what came through overnight. President Trump issuing this reprieve. China hasn't been spared, but still it is looking pretty positive today. Other things to note as well, really big moves in the currency as well. Yeah, and I think the CNY, because of a lot more flexibility allowed by a slightly weaker fix on a day-to-day basis, has allowed the currency to actually hit the weakest level here since 2007 on the onshore rate. So that's CNY, not CNH, 735 handle as far as that is concerned. The other things, of course, we're tracking here, everything from turnover, volume, stock connect flows, and everything in between. The intersection of that really is a question, and I'm posing it, how much state support is this market getting? And really one good proxy of that is looking at ETFs that track, of course, the benchmark. And as you can see, we're also called substantially 2 to 3% high on these onshore trackers. Right. Back to the point we were making earlier on, HS Tech, 6.3% now. So just compared to Bell's point, just 5-10 minutes back, we're getting another leg higher as far as this is concerned. There we go. And the currencies, the 10-year yield, bottom of your screens. We'll have a deeper conversation around the currency in about 10 minutes or so with Becky Liu.
should be joining us in about 10 minutes. Very, very quickly, the rest of the region is doing very well, tracking the 10% gains that we had on Wall Street. U.S. futures are falling. European futures are on the way up. What you don't see on your screens, but I guarantee you it's going to make headlines in a couple of minutes when it starts trading, will be Vietnam. And that market comes online, and expect that one to go through the roof today on the back of the move we're seeing globally, plus, of course, more Vietnam-specific news flow coming as it pertains to tariffs and opening up the conversations there with the White House to hopefully bring those barriers back down. Now, really, more on that, but on the China side of things, more from President Trump's decision to raise tariffs on China to 125% from 104%. At the same time, he also announced a pause on higher duties for dozens of other, as we were just pointing out just now, trade partners.
I did a 90-day pause for the people that didn't retaliate, because I told them if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate. So we'll see how it all works out. I think it's going to work out amazing. I think that our country is going to be at the end of a year or shorter, but I think we're going to have something that nobody would have dreamt possible.
For more, let's bring in our Bloomberg News desk editor, Jill Deeses, joining us this morning. And Jill, I wonder how this flip-flopping, essentially, from President Trump is going to be interpreted, because just at the start of the week, the advisors and the members in his administration were telling us that he would not relent. He obviously has. How is this going to also factor into these negotiations with countries like Vietnam, for instance, but others, Korea, Japan, that are holding talks?
Well, yes, Val. I mean, that's kind of the issue here, right, is that a lot of these countries didn't really even know going into these negotiations how exactly things were going to play out. I mean, as we've been talking about over the past week, a lot of these higher tariff rates were sort of calculated based on deficits. We know that Trump doesn't want to hold deficits between the U.S. and he doesn't want the U.S. to have a trade deficit with other countries, rather than, these being calculated purely on reciprocal tariff levels. So that was already kind of a frustration that entered the picture. But now you've got Trump choosing to, effectively reverse himself. Obviously, the Trump administration has portrayed this as, oh, well, we actually saw a bunch of people coming to the negotiating table, and so this is exactly what we wanted. They count this as a victory. But I mean, look, Trump himself over the last 24 hours pretty much made clear that a lot of this was driven by, some fears of about what was happening in bond markets. I mean, he said, everybody was starting to get a bit yippy, hours after telling everybody to be cool and basically buy the dip. So, I mean, clearly he's paying attention to how all of these measures are affecting markets. I'm sure he's very happy with a lot of the drives that we're seeing, overnight, and, we'll see what happens tomorrow. But it does, if you're one of those negotiating partners on the other end of this, these other governments, I think there's still a lot of questions as to what ultimately would lead to a trade deal with Trump over the next 90 days that makes him happy, that doesn't, involve making, just impossible concessions from their part.
Now, Jill, I guess more specifically on China, right? We were having a conversation earlier on in the show with Goldman Sachs, and for us to go from, say, 50% to where we are 125%, I forget the numbers, in this case 104% to 125%, really doesn't matter once you're past a certain extreme. But the reason I simply underscore that is President Trump, while we are at extreme levels, has indicated that he doesn't actually see this number going up even further.
Yes. So he did just tell reporters that he doesn't see this going higher. But I think, as you mentioned, David, you sort of just get to a certain point where these numbers where, it almost feels a bit farcical, right? Like, you started at, 40, 50%, moved to 104, moved to 125%. He's obviously framing this as, China is refusing to come to the table. So if the Trump administration is saying, look, all these other countries, the reason why we're holding off on these higher duties is because they've actually, indicated a willingness to play the game. China is taking a completely different tactic. I mean, just overnight, they raised, they said that they were raising tariffs on American goods into China, even higher. So you are seeing that escalating trade war between the these two. I think the ultimate question here, though, is that you've got the U.S. and China, the world's two economic superpowers, biggest economies in the world, that are kind of stuck in this game of chicken right now with each other. And there's a pretty serious question over, is there a way that one bows to the other first? I mean, you've got, kind of strong men on either side, Trump versus Xi Jinping. It's really unclear as to who ultimately, sort of balks first. I would say, obviously there's economic concerns, domestic economic concerns on both sides of the equation. China just posting, some not particularly favorable inflation numbers. Obviously, Trump has to be concerned at some points about inflation, on their side of it. But yeah, I think at this point, it's really, really unclear, David, where you actually reach a point where these two economies can negotiate with each other.
Jill, thank you so much. Jill Deesis there, our Bloomberg News desk editor, for more insight on what all of that and all those moving parts mean for markets. And do you buy into this rally we're seeing right now? Is the floor in? Is this Trump put on equity markets? Is it a fixed income story? Let's bring in Mark Cranfield out of our MLive team, joins us out of Singapore. So, Mark, just two things, right? Asian equities are following U.S. cash markets, but U.S. futures are now falling. How do I read into this? What does this tell us about the next 24 hours?
Nothing. Absolutely nothing at all. It hardly tells us anything about the next 1 hour at the moment. Traders have shortened their time horizons so far. Right now, what they're trying to do is to sieve through the debris of the past week, and they're trying to establish, are there any patterns, are there any themes that we can actually hang on to for more than 24 hours? So there's a couple of things starting to emerge here, which you probably will see get some traction over the next few days at least. So let's see. The Chinese yuan is gradually being put on a path to a weaker level. Traders seem to be fairly confident of that. The PBOC has set the dollar-yuan fixing higher for 6 days in a row. So I think people can take that as a fairly clear signal that is endorsed. We will get a weaker yuan on a gradual basis. What that means for Asian currencies is that you need to calculate that into your positioning for Asian currencies in relation to major currencies. That means that Asian currencies are likely to underperform major currencies for a while yet. Traders are recalibrating along those lines, and they're looking at currencies like the euro, the yen, the Swiss franc as the primary beneficiaries of money which is moving away from the US dollar. Not all money is moving away from the US dollar. You can see that in the performance of the Indonesian rupiah, the Indian rupee, those kind of things. But quite a bit of money is starting to shift into a few major currencies. You can see that in the option market. Very high volumes for the euro, pound, and the yen especially. So those themes are starting to get a little bit of traction. Equity space, much more complex. Yes, we're seeing rebounds in various places, but look where they've come from. Look at the rebound for Japanese equities. Quite impressive today. But look where it was back in the middle of March. We're hardly even halfway back to where we were in those stages. And that same thing applies to several markets. Equities are going to take a lot longer to settle down, especially as you mentioned earlier. There's the potential for a Trump put, and that could change as well. It looks as though it's more directed at the fixed income market than the equity market. So bond traders are now looking at it and saying, at least we may have some parameters on where yields can go. That incredible turbulence that you saw yesterday on an intraday basis was historic. 10 and 30-year yields in the US especially, creating ranges we haven't seen for many, many years. And so finally, even Donald Trump got his attention and he did something about it. At least we've got some idea where the pain threshold is in the bond market. To be honest, we have no idea where the pain threshold is in the equity market. It is a derivative of bonds for the time being. Those are some of the things that traders are beginning to look at. And we haven't even mentioned commodities yet.
Well, do you want to mention commodities, Mark, or what else are you focusing in on? Because I'm also wondering about the equity market and this 90-day pause. What happens in the next 90 days? I mean, I think we can expect lots of negotiations. But do you see, is it more range-bound, or, as you said, it seems like we haven't found the floor yet for equities or stocks just yet?
I suspect that the more that we hear on the way we're going towards negotiation things, the more difficult it will be for investors. In a way, it will be much simpler if we don't hear, if we we've got a 90-day pause, and investors are told, OK, you won't hear much until the end of that period when we can give you clear signals on what agreements may look like. In which case, we'll probably get equities will drift around. People will be looking for value among some stocks that have been beaten up more than others, and we'll get a bit of a sense of direction. The trouble is, that's not very likely to happen. We're going to be probably hit with a lot more headlines. Headline risk has never been higher. You can see what's happened just in the past week. Markets are so jumpy every time there's a new headline, not just from Donald Trump, but from leaders of other countries, from central bank people. We're just jumping from one event risk to another. And that's why the markets, sometimes they look a bit like headless chickens. But it's no wonder. People are trying to manage money and make decisions on the fly, when really what they need is some kind of surety that they can make a view for weeks or maybe even months at a time. That's just not the case right now. So we're just going to have to live with it.
Mark.
That 90-day period may become 180 days or even longer. Let's see what happens there.
All right, I like that analogy because there's obviously, Mark, that point that people are making. Trump's playing a game of chicken, and then, as you say, that could be making traders or investors headless chickens as well. So, all right, lots of chickens. That's Bloomberg and my strategist, Mark Cranfield, there. And taking a look at some breaking news as well that just crossed the terminal this morning. We do have Prime Minister Ishiba nominating a new person or a former executive, rather, at Mitsubishi to join the BOJ board at the end of June. This is Kazuyuki Masu, as I said, a former Mitsubishi executive. That would be really a new voice at the central bank, essentially, because it's going to be, of course, like other central banks, really trying to navigate this increased uncertainty.
Yeah, well, good luck to them. I wouldn't want to be in a central banker's shoes right now, particularly the Fed, right? When you have inflation expectations on the way up, but growth expectations really just falling down the drain. Speaking of, we have a central bank decision today out of the Philippines. We'll talk more about that and what they do and what the orientation is. Can you cut rates while the dollar is strong? Complicated. While you look at markets with Z-scores like this, who needs volatility? This is Bloomberg.
If you look at the magnitude of a change in USD-CNY, it's not that big, right? 335, 340 is a very small change. So we don't really think this is really aiming at offsetting a 100% tariff. The type of a currency, not even close, right? So I think of this as letting off some of the pressure, currency depreciation pressure. And I think this is perhaps another indication that China's reaction function is somewhat different.
That was Shan, their chief China economist at Goldman Sachs. We were just having that conversation about, I'd say, 40 minutes back, as headlines hit that the onshore currency has now hit the weakest level here since 2007. This chart takes you back 20 years, and we've gone from, the days of 2005 at 825. You had that revaluation to about 811, if my memory serves me correctly. And we're at about that level, right? Do we test the higher end? What is the higher end, given the changing dynamics of negotiations, the prospect of a deal, and what China needs to do in the interim to, I guess, shelter its economy? Let's bring in Becky Liu, MD and head of China macro strategy at Standard Chartered Bank. What is the best way to describe the attitude towards the currency right now?
The entire playbook has changed. The PBOC set the official fixing beyond 720 for the first time in 1.5 years' time, immediately after Trump threatened for another 50% earlier this week. So currently, I don't think the absolute currency stability remains to be a priority. And that used to be a key hurdle preventing China from easing further from here. So the playbook has changed in a way that the focus is really going back to domestic market, stimulating domestic market through fiscal monetary policy, and therefore letting go the CNY will allow them to regain monetary policy as well as independence from the Fed and allow the PBOC to start easing much more aggressively from here.
You've changed your expectation as well. So what are you now seeing for the CNY?
So instead of defending the line of 735, we expect the PBOC to allow a measured depreciation of the CNY against the dollar by about 5 to 10% before the end of this year. And dollar is more important than the basket in our view. So this would have a number of benefits. Aside from regaining monetary policy flexibility, they would also allow the exporters to partly mitigate the pressure from the loss of external demand, because the bulk of their export incomes are tied to dollar, but the cost base are tied to CNY. So that would partly support their profitability by devaluing the CNY a little bit. And it's also helpful to partly alleviate China's deflation pressure at home as well. So we are now looking for dollar CNY gradually edging higher to 755 by the end of the second quarter and 775 by the end of this year.
That sort of depreciation level, I could be wrong here, but I think that's sort of similar to what we saw in the first trade war, or the first term that Trump had in office. This time around, though, the relationship is a lot more hostile between Washington and Beijing. So you don't see that we could see, I mean, some are saying we see the yuan weaken 30% against the dollar.
This time, we believe that the reason why they weaken the CNY, it's not to offset the implication from tariff. Tariff at today's level, 125%, is impossible to be offset by any form of currency depreciation. So that's a different playbook compared with 2018 to 19. And also during that time, China was looking for demand elsewhere, outside of the U.S., to basically sell more to the rest of the world. But today, even after this pause for 90 days announced by Trump overnight, he is still keeping the minimum of 10% of tariff. So that means that incrementally, the U.S. demand will still be more serviced by domestic supply rather than supply in the rest of the world. So currently, no one have excess demand in the rest of the world, and everyone have a little bit of excess supply. So it's the reason is really not to offset the tariff impact, but to regain much more monetary policy flexibility.
So what does it mean for rates? I mean, if this opens up more possibilities for the PBOC to move on other levers, what do we need to be expecting?
So we believe the PBOC could start easing again and more aggressively, including both rate cut, cheap-hua cut. We even see possibility for them to be cutting as much as 20-30 basis points this month in the OMO rate. And for the full year, it's possible to see 40 to 60 basis points of cut, which would be more than 30 basis points last year. So although people would argue that monetary policy is less useful, but it would facilitate smooth execution of fiscal policy as well. We have already seen the government front-loading a lot of the bond issuance so far this year. For example, CGB net issuance more than tripled in the first quarter of this year. So clearly looking to accelerate the pace of fiscal spending, and a easier monetary policy could allow cheaper funding from the monetary finance and smoother bond issuance, and possibly a further step up of fiscal deficit later this year.
Do you think, though, even easier monetary policy conditions really will have the desired economic effect in terms of actually stimulating growth and consumption within China?
It's going to take time. One is that this time around, due to all the uncertainties, global economy will still likely to take a hit. Like at this stage, who really want to invest, like either in the U.S. or outside of the U.S., like given all these volatilities in terms of policy making. So that's why that means external demand has to decline quite a bit. And from this perspective, we are seeing China's net export contribution to GDP was 30% last year, and this is a very big gap to be filled. So together with monetary policy, fiscal policy, it helps to alleviate the pressure, but they might need to step up in a much more material way later this quarter when the external demand is really collapsing. So we do not rule out the more aggressive both monetary and fiscal measures, such as QE or consumption coupon later this year.
That also, it seems we're back to looking at the Chinese currency now as a funding currency on the carry. Is that something that you expect to happen meaningfully? Yes. It looks like we're going to see rates go to the floor right now.
Yes, we do expect rates to lower, to decline from here. We actually just adjust our 10-year CGBU forecast further lower to 130 by the end of this year. So CNY will likely to stay, or CNH will likely to stay a funding currency from here on. But it's also China's desire to modestly depreciate this currency, in particular under the backdrop that the DXY it's actually less strong than what people were expecting previously. So we are now expecting the CNY to primarily depreciate against the dollar. It's harder to argue how it's going to perform against the basket of currencies. So even under the condition when dollar is relatively weak, the low interest rate for CNH will continue to be a factor pushing up dollar CNH and dollar CNY for the subsequent part of this year.
Should we just call this a decoupling? The scenarios you've outlined here, currency at 770, 1.3 in the 10-year yield. It looks like, and I'm going to borrow a phrase here, it looks like Chinese officials are gearing up for an economic war.
I think they are almost already at an economic war. So if we look at historical experience, any tariff that's north of 40 to 50% are already highly restrictive for any trade to happen. Currently at more than 100%, it's basically sending bilateral trade to a sharp deceleration from here on. And therefore, this would be a rapid and fast decoupling, at least from a bilateral trade perspective. And a reduction of economic ties will likely to raise the tail risk elsewhere, outside of trade, outside of economic issues, into other issues. So we do expect market to stay highly volatile in the foreseeable future.
Becky, really great to have you this morning. That was Becky Liu, the MD and head of China macro strategy at Standard Chartered Bank, and we were just discussing there as well. I mean, tariff reprieve, of course, is really the main story in the markets this morning, and you're seeing that reflected because we've just had Vietnam stocks coming online this morning, surging the most all the way back. That is quite not a superlative, but I mean, going all the way back to October 2001. So certainly big gains that we're seeing here. But the story, of course, is that Vietnam and the US have agreed to start negotiations on reciprocal trade agreements. That's after talks that got underway in Washington. So we'll have more on this ahead. You're watching Bloomberg.
All right, welcome back. Just a look at some of these rubber-related stocks over in Malaysia. So you have, of course, some of the glove stocks, among other skin surface tapestry materials that a lot of these guys use here. On the up, on the back of Donald Trump raising tariffs on China and perhaps could pivot some of the business into, I see Top Glove, I think of COVID. This is really one stock that really gained substantially 5 years back as the world was scrambling for medical gloves and PPE. And you know what? Markets right now are acting like we're just entering COVID 5 years back. Plenty more ahead. This is Bloomberg. Okay, we're just going into the Japanese lunch break, and I don't know where to start. I have a Bloomberg terminal and I have multiple screens open, and yet it seemed to be insufficient to give me a total picture of what's going on. Or maybe just close your eyes, and really that's perhaps one thing that really gets us into the weekend. What we're seeing today is a complete reversal from this time yesterday, where risk assets were an offer. Risk assets, as you can see, are largely bid. It's more an equity market story than it is a bond market story. It's certainly more a bond market story than it is an FX story. But yeah, all that being said, the latest headline to cross right now, the terminal, is the Indonesian rupiah is seeing the biggest move in a month to the upside after hitting its lowest level effectively here on record. Also, case in point, just to mention, we have a central bank decision later today out of the Philippines and how they frame really what's going on. And they have been fairly straightforward and forthcoming in terms of being active in the market. I wonder how active the BSP is this week. I would imagine very much so. In any case, of course, that's the FX market story, Bill.
Yeah, well, taking a look at as well what's happening in the commodities market, very, of course, dollar sensitive, but we do see Brent crude, I mean, this is a two-week check
look,
here.
yeah,
Okay. So we've seen...
Although you could make the mistake of saying this is a one-day move.
Well, I nearly did it. I thought, no, this is not accurate. But essentially, I mean, it's been a very volatile run. I guess that's what you could say in aggregate for every element across this board. Let's get more on it now and bring in Dominic Schnider, Head of Global Commodities and Forex at UBS Global Wealth Management, CIO. Standing out to you this morning, we were just talking about gold there, and certainly there's been that big question when we had seen it pulling back a little bit, but there were questions as to why we were seeing it as well under pressure. What's your expectations of where we go from here?
So we remain quite positive on gold, looking at the $3,200 an ounce, potentially even higher, depending on what kind of macro environment we're going to get. But I think the rationale why gold was under pressure a little bit, look, when all assets fall quite rapidly, gold holding up, that's already a material outperformance. So I think that's quite normal in an environment where also there were fear about the bond market freezing up, people at margin calls. It's hard for gold to just really roar in nominal terms. In relative terms, it did well. But I think the next step is going to be at some point still the Fed coming in, and I think that gives us the next leg up in gold. And then obviously in that context also the dollar likely to weaken.
You mentioned something there. It depends on what the macro environment will be. What's the macro environment gonna be?
Well, that seems to change on a daily basis.
Right.
But I think it's clear that we're going to have a situation where, investment is going to be impacted. Let's be frank. Even if we from here get the turn into a more positive trajectory, probably people are going to hold back on investment activity, so things are going to slow. So we're still looking at U.S. economy, probably going to be growth sub 1%. There's still room in that case for growth expectation to be lowered. Europe's going to stall, and China somewhere 4% or below. So I think we're still in this environment where things going to slow down. Hopefully it's not going to be as dramatic. I think clearly oil prices, which has come down quite a fair bit, is a helping factor. Don't underestimate that. I mean, these are billions of savings for consumers, and I think that needs to take into consideration as well. So we're not fully bleak, let's be clear, but slow down.
I mean, it's effectively a rate cut if you think about the drop in oil prices. Does OPEC Plus come in at some point to support prices? What do you think about the oil price right now?
Well, I think OPEC Plus tend to be more reactive than proactive. I mean, managing mostly supply and demand rather than managing prices per se. So a lot need to happen for prices first, I would say, for OPEC Plus to really come in and give here a supporting to the oil price. I think what I'm more looking at is with the pullback, how quickly U.S. supply growth is actually moderating. I think at these levels we already see some estimates being rewind lower. So I think that development is helpful. But look, as long as you think maybe global air traffic is going to slow down, global trade is going to slow down, it's obviously hard for oil to really perform. Still, I would ask, second half of the year, we're still probably going to trade above $70 per barrel in Brent.
If global trade is going to slow down as well, I mean, that obviously has a big bearing on the outlook for copper. So what are you expecting there?
Yeah, look, copper had an interesting story because normally in the tariffs last time, copper and the industrial metals really suffered. And then we had these tariffs from the US, which created this artificial import demand into the US. I would say copper is going to go nowhere, at least short term. Still, there's a medium-term story to be said, so I would say we're going to be longer term in a deficit. So if you have that element in mind, it should still crawl higher. But I think given the uncertainty right now, it's hard to see a more bullish price. I think the strategy to deploy, and I think that's what we were looking at, is wall selling. You might want to pick up copper at the lower price, knowing that it has that structural story. And let's be frank, the VIX is not going to stay at elevated level for long. At some point, we have seen Donald Trump will blink again, hopefully, and then the longer-term narrative can kick in. Yeah?
What's happened with just a hardening of the stance on both sides on tariffs is that, forget the ridiculous levels we're at right now on double-digit tariffs on each other. The Chinese have started to adjust the midpoint of the currency ever so weak or slightly almost every day. And, a lot of the guests that have come on the show just today have said this is a new game we're entering, that the yuan will probably see a lot more weakness over the short term. What does it mean for the currency markets?
Look, if there would be obviously a doorstep devaluation, which is, by the way, not our base case, I agree that we maybe crawl a little bit higher. We're looking at 7.4, and we can think about 7.5. By the way, there's no incentive and there's no benefit from doing a doorstep devaluation. CNY in real terms, trade weighted, has already come down a lot. And you're not going to make yourself more competitive. Let's be clear here. But if you would think about in this extreme case, well, it would have broad knock-on effect on Europe as well. I mean, then you would see the euro, which has held up extremely well, starting to go in reverse gear, because you would think about what about the export here, competitiveness, and then also here for the region, obviously, you would have that broader weakness across the complex.
Yeah. Well, I think the argument wasn't so much, to your point, though, to offset the tariffs. I mean, you need an exchange rate at 20, let's say, just pulling a number out of my hat to offset tariffs. But the ability, I think, for the PBOC to then massage monetary policy into the system, which I think the economy needs at this point in time. Do you think other central banks, other economies are looking at the yuan right now and saying, we might need to allow more weakness in our currencies on the back of what we're seeing there?
No, I think all the central banks at this point in time rather want to have stability. I think that's the main focus here. So I'm not sure anybody is really interested to do a bigger devaluation in order to gain some form of competitiveness. Where you maybe had seen already some weakness, let's say in Indonesia, where you had some question marks. I think here, private outflows potentially continues. But I think overall central banks are looking for more stability than anything else. I mean, I just really want to say when it comes to the CNY, a modest weakness, I think that's part of the game, I would say. But ask yourself, what's the benefit? You open so many questions about sustainability, where does it go, uncertainty, even uncertainty in China itself, that is not warranted. So I think I see no benefit. And looking at the trade dynamics and trade surpluses China had into all that kind of tariff dynamics, I think there's no need to do a doorstep devaluation.
In one of your recent notes, you talk about your so-called opportunity of the week, but it was revolving around the Canadian dollar versus the Mexican peso. So are you still seeing that, given that they still continue to be relatively tariff insulated?
Yeah, I would say, look, on the Mexican side, you do have a fair bit of carry, and I think we want to capture that kind of carry. Clearly, you maybe at this point in time, given the back and forth on tariff dynamics, you don't want to be long Mexican peso basically versus the dollar. So you want to find an offsetting force that can, if things deteriorate, can soften the blow and bring forward a little bit of carry. And I think the Canadian currency is an opportunity to be short and try to be a little bit more relative value here. I think that's the main game. Who knows on this risk on, risk off can change within a day. So you're looking for more value in the crosses.
Yeah, what we need is a very strong anesthetic to carry us into the weekend and through the weekend.
Probably.
Just pass all this noise and hopefully wake up with in a stable world on the other side. Dominic, fantastic, taking the time to speak with us right now. Dominic Schnider, the head of global commodities and forex at UBS Global Wealth Management, CIO. Just looking at markets, we're about going into the 17-minute mark. Cash markets here, and strong rally, 5% on HS Tech. Plenty more ahead. This is Bloomberg.
China wants to make a deal. They just don't know how quite to go about it. It's one of those things they don't know how quite. They're proud people. And President Xi's a proud man. I know him very well. And they don't know quite how to go about it, but they'll figure it out. They're in the process of figuring it out, but they want to make a deal.
As I've repeatedly said, and President Trump has been saying it for years, China is the most imbalanced economy in the history of the modern world, and they are the biggest source of the U.S. trade problems. And indeed, they are a problem for the rest of the world.
That was the US President and Treasury Secretary speaking about 125% tariffs on China. That's after Beijing slapped on its own retaliatory duties as well. And the trade war, of course, as you can expect, it is front and centre in Chinese state media coverage today. Taking a quick look at that as well, newspapers, including the People's Daily, have published the full text of China's so-called white paper that's outlining its official position on trade relations with the US. The document accuses Washington of failing to meet its obligations under the Phase 1 trade deal signed in 2020 and undermining economic and trade ties.
Yeah, meanwhile, you have the Global Times in today, at least the version today, edition today, blasting what it calls U.S. unilateralism, saying it infringes on other countries' right to develop. It also warns that the quote, selfish and short-sighted approach will ultimately backfire. Let's bring in our China correspondent, Min Lo, to talk us through this. This white paper and the finer points, just take us through what those are and perhaps the big picture there.
Yeah, it's a very lengthy document, close to 50 pages, 6 chapters, full of anecdotes, examples, statistics, evidence to show how China has earnestly fulfilled the terms of the Phase 1 trade deal and how the U.S. hasn't. So examples include how China had opposed forced tech transfers from U.S. companies to Chinese companies, how it has opened up some of its markets, and how it has maintained the stability of the yuan. And then in terms of how China had failed to keep up, maintain its pledge on buying a certain amount of U.S. goods, it said that was because the pandemic has caused U.S. production levels to fall below pre-pandemic levels that prevented China from buying up the amount they had initially pledged. They also said that U.S. prices were uncompetitive, and it didn't make sense for Chinese producers to buy things at higher prices from the U.S. when they can get it cheaper from other countries. And then it cited how U.S. failed to keep up its end of the bargain, including how, for example, the U.S. had sort of put pressure on Chinese tech transfers, citing TikTok as an example, how it has placed restrictions on Chinese-related investments, export controls, and the like, and also said how China really wasn't deliberate in trying to maintain a trade surplus with the United States, and that, you look at how the U.S. trade deficit has grown globally, the proportion attributed to China had actually fallen. So that's their argument. So in plain speak, it is saying, look, we, China, we've been the good kid, we've fulfilled our end of the bargain. U.S., you've been a bad kid, but you know what, we're still going to be reasonable. We want to have dialogue if you're ready to do so, but if not, then we will, quote, fight to the end.
So what have the reactions been on social media then to this?
Yeah, there's so much chatter on social media. 7 of the top 10 topics on Weibo today had been about those tariffs. And as expected, there had been a lot of very nationalistic comments. So people saying that, our ancestors, our forefathers didn't bow down. Why should we bend our waist? We shouldn't leave this battle to our next generation. And when the Chinese people cite their next generation, they're really hunkering down for an epic battle. And another comment saying that Trump tried to kick the steel plate down and how he has hurt his feet. Here is a sarcastic one. Manufacturing is back to the U.S. within 3 days. It is laughable. I thought I was watching an epic war movie, but it turns out to be comedy. Also, some rallying cries as well. The next comment here saying, support the country, support the party. The impact of this is going to be big. But I really thank the country for letting us straighten our backs and giving us the confidence. And we want to show the country that nobody else is more united than the Chinese people. And it's interesting, instead of inciting social instability because of the economic hit, the tariff war is actually causing the Chinese people to coalesce together and rally tighter together against this enemy, which is the United States.
Yeah, I guess that's one of the main pieces of analysis so far, is that in China, really, the time horizon can be very different for looking at these sorts of negotiations and relationships with other countries as well. But that was our China correspondent, Min Lo, there. And we'll have plenty more ahead as we continue, of course, to assess all of these market moves in the session so far today. Taking a look at the Hang Seng Tech, for instance, you're gaining 4% there. A little bit off the highs of the day, but still in positive territory for the most part. That's it for this block. Actually, we're going to the ad break.
Yeah, a few minutes more. You're already
10 minutes.
You're headed for dismissal already, Belle.
All right. Anyway, we'll be back in a couple of minutes. This is Bloomberg. Well, Lego's CEO is downplaying the impact of tariffs on its supply chain. That says the world's largest toy maker opens a new factory in Vietnam. But Niels Christensen told Bloomberg he's watching how trade tensions impact consumer sentiment.
For the last 15 years had the strategy of being regionalized in our supply chain, because Lego boxes are pretty big and shipping them around would not be good either for CO2 or for costs. So we typically produce within the region that we sell to consumers. So basically most of what we sell in the US we produce in Mexico, or in the future in the factory we make in Virginia. Like this factory in Vietnam is then to serve Asia Pacific together with the factory in China. So in that sense we're a little bit more resilient than most companies up against tariffs. So in that sense we as a group will probably be able to cope pretty well, and it won't have a big influence on what we do, and it will not have any negative influence on this factory because it was never thought about as this factory should be serving different parts of the world. So this factory will be much more dependent on how well we succeed in spreading the Lego brand in Asia Pacific. And that's of course a big opportunity for us.
Do you expect that there would be impacts on your global supply chains due to tariffs?
I think probably less so on supply chain. I think it'll more be a matter of what does this tariff thing do to the overall sentiment of consumers around the globe, and will it mean that people get more nervous or spend less? We'll have to see what happens, but I think it's less of a supply chain issue for the Lego Group. It's probably more a world growth opportunity, and that's why I'm happy to be here, because the opportunity here for us I think is big, no matter whether there's tariffs or not. So hopefully we can also balance some of a potential negative thing coming from tariffs by growing into new countries.
You just mentioned that there would be a decrease in consumer spending due to tariffs. Do you expect any hit on revenue or overall business of Lego in the coming time?
It's hard to say. We haven't seen it yet, and I don't think typically what we do is not the most sensitive to GDP growth or stuff. So we'll have to see what it is. We've enjoyed over the last couple of years that we've been able to take market share. So we've been growing way faster than the market. So even if the market gets impacted a bit, I still have the hopes that we can continue to gain market share and perform stronger. So it won't change our strategy. We will keep investing, and as a family-owned company, we don't live for the next quarter alone. We also live for the long term, and we make investments like this factory, but also behind brand and portfolio with a longer term perspective. So I hope that way we can actually balance whatever might happen.
That was the Lego CEO Niels Christensen there speaking to Bloomberg at their new factory in southern Vietnam, and sort of undaunted by this prospect of high tariffs. But actually, you're seeing as well that relief really this morning, because Vietnam and the US have already agreed to start their trade talks as well.
Yeah, and this was really an extreme pain point in the markets. This specific group of stocks that companies, not just in Asia Pacific but in the US, Western companies that have expanded their production capacity for various reasons, right? Whether that's supply chain diversification, China plus one. It was a trend that was, in fact, starting well before the pandemic, the move towards a cheaper cost base in Southeast Asia. And when that gate closed temporarily with the news flow and then reopened today, you're getting a really, really big pop across a lot of these stocks that, again, suddenly are now faced with a non-disruption and a non-story. But, let's wait until they sign that deal, shall we?
Yeah, non-disruption and a non-story, I think is going to be really challenging, because this reprieve, of course, is only for 90 days as well. So it's just going to be really keeping a check on all of these negotiations that are taking place.
Yeah, but
well, I mean, we can also talk about the reprieve, but how corporate America as well is still saying that they're gearing up for recession, because this is one of the stories on the terminal this morning. Thinking about how even with, some sort of breathing space now for 90 days, still the base case is that you've really injected a lot of uncertainty, and that makes consumers nervous as well.
And corporates and capex spending and, how much inventory do you build and resilience do you now build into your system, not knowing? I mean, I can see how it makes complete sense, to build up your inventory or supply chain when you have uncertainty of, say, a pandemic, for example, right? Because you have to make sure you have the stuff in case you need it. But in the event that you don't know where to build your inventory because you don't know how tariff settings are going to set up, that's an additional layer that people have to consider, right? I forget whose note this was yesterday, to your point, that Russell 2000 is in fact priced for a recession, apart from, of course, all the other blue chips coming out with their own guidance here in recession.
Yeah, and actually on that point, I mean, Amazon, for instance, which you just saw in the graphic there, but they're one that's already cancelled orders or multiple product orders from China, for instance, off the back, of course, China exempted from the reprieve so far. What's interesting as well, just on the consumer front, something that I was reading this morning was about how of the percentage of American credit cards there's now a higher proportion that are starting to only make their minimum monthly repayments. So people are already feeling the pinch, and that's before you even start to see the inflationary impact of these tariffs.
Yeah, and thank to the high heavens that the borrowing cost scare that we had on Tuesday and Wednesday sort of pulled back, because that's going to be the pain point there on credit card spending. But, night is young. We'll see how the story goes. Have markets found a floor? It's another way, really, of asking the question. Just very briefly, on these Chinese markets, the southbound flows yesterday across the Stock Connect hit a record 35 billion Hong Kong dollars. We are positive, but we're nowhere near those levels going into the last part of the morning session. The other story here, as we wrap up today, is a Chinese currency that has reached the lowest level in 2007 on the onshore rate. A zoomed-in version of this chart will show you, there we go, that we have hit the upper limit on dollar China from the allowed range. On that note, we are ending on a fairly positive note here. Equity markets across the region are bid substantially here, Belle.
Yeah, so that is actually it now for the China show. We will be leaving you here. Insight is next with Haslinda Amin. More ahead. You're watching Bloomberg.